Hello and welcome to the video tutorial on standard costing and variance analysis. In this video tutorial we're going to look at the Budgetary company and we're going to work through the question and the solution. If you'd like to download this question, you can download it as a PDF file from my website, danielkingaccounting.wordpress.com. You can download a range of other questions with links to video tutorials as well. Okay, so moving straight on to this question. Here we have the Bright Paint Company. Starting at the top, the Bright Paint Company produces product R, which has a unit standard cost as follows. Now they're in containers, but we're just interested in the unit. So you have direct materials. It takes 1.5 litres of material to make a unit, and the cost is €5 per litre. That gives a total cost of $7.50. The direct labour, it takes 1 hour to make a unit, and the labour is paid €3 per hour, which is €3. Variable overheads come to $1.50. Fixed overheads are €2 per unit, and the total cost per unit is €14. The selling price is budgeted at €20 for each container, that's the unit, and the budget quantity to be produced and sold each month is 50,000 containers. Variable overheads are absorbed by labour hours, now that's generally the case, and fixed overheads are absorbed by units. The actual results for the month of December were as follows. So here we have the actual information. So they actually sold 48,000 units and had revenue of 964,000. The costs are given to us there, and they actually made a profit of 274,700. Now let's just go down and see what we're asked to do. In this question here, we're asked to prepare a budgetary control statement in a marginal costing format showing the original fixed budget, the flexible budget, the actual results, and the variances. So this bit here gives the structure of our table, or the statement. So we're going to have 1, 2, 3, 4 columns, one showing the original fixed budget, one the flexible budget, one the actual results, and then one the variances. And with all that done, we're going to take 2 of the variances, the material and the labour variances, and we're going to subdivide them. So we're going to work out the following sub-variances. So for the materials, we have a material price and a material usage variance, and for the labour, we have a labour rate and a labour efficiency variance. So what we're going to do, we're going to start off by looking at our budget control statement, and what I'm going to do is I'm just going to drop in here a template that we'll be using. So this is our budget control statement. Now do remember, you can pause, rewind, and play at any time during this video tutorial. So what I'm going to do is I'm going to start by constructing this, or filling in this particular budget control statement, and I'm going to start off with the original fixed budget. So we start off by reconstructing the original fixed budget. Now, what I'll do is I will put in here the original budgeted units. So if I go back to the question, we can see that the original plan was to produce 50,000 units. So I'm going to put that in there. And then everything else is going to be money. But what I might do here, which can be quite useful, is I might just put in the unit price and costs. Now we're given that information, so if I go back here, we can see the budget selling price is €20, the materials $7.50 per unit, the labour €3 per unit, and the variable overheads $1.50 per unit. The fixed overheads, well, they're not really unit costs, they're more period costs, so that's it. It's just absorbed at that rate. So we'll ignore that for the moment and we'll come back to it. But these 3 figures here, plus the selling price per unit, are the figures we're interested in. So we'll pop them in here. So we have, again, a little heading for euros. We've €20 there as the selling price per unit. We have material cost of $7.50 per unit, direct labour €3 per unit, and the variable overheads $1.50 per unit. That gives a total of €12. Of course, what we can actually work out here now is that if the selling price per unit is €20 and the total variable cost is €12 per unit, well then the contribution per unit would be €8. Okay, so what I'll do is I will start filling in then the fixed budget. So what we're doing here now is we're reconstructing the fixed budget. You can see from the actual question, if we just go back here, They give us all the information we need, but they don't actually give us the fixed budget, so we have to actually reconstruct it. But it's quite easy here because we've done most of the set up most of the information we need. So what we're basically saying here is that they're going to sell 50,000 units, and they're going to sell each unit for €20. So therefore, the budget or projected turnover would be €1 million. Now, we need €7.50 worth of materials for each unit we make. So 750 by 50,000 will be €375,000. So that is the budget or projected cost for materials. Labor, €3 per unit times 50,000. So that would be 150,000 would be the expected direct labor cost. And the variable overhead, 150 per unit times 50,000 units, will be €75,000. Now if I add these three together, I get my total variable costs of 600,000. And then I have my total sale revenue minus my total variable costs will give me a contribution of 400,000. Now, the original fixed budget, well, I'm just going to have a quick look at that. The original fixed budget for fixed overheads, I need to go back to the question and have a quick look again at that. So what we can see here is that the plan is to produce 50,000 containers. So I'll just make myself a bit of space up here. So we've 50,000 containers, and the amount that's going to be added on to each container to cover the fixed costs is €2. So €2 is the amount that will be absorbed onto it. It's not actually a cost per container. It is a sharing of the cost among the 50,000 containers. So that would imply that the budget for the fixed overheads is 100,000. So what happened here is that the projection for the fixed overheads was 100,000. The plan was to make 50,000 units. So therefore, if they added on €2 to each unit, they cover the costs if they sell the 50,000 units. Okay, so in fact we're working backwards from this one. But do remember, a fixed overhead is an overhead that, in theory, isn't affected by changes in the level of activity. So the fixed overhead should be 100,000 no matter what. So what I'm going to do is I'm going to pop that figure in. There's the 100,000 there. Now, what I usually do is I add up my fixed costs here, my fixed overheads, and I get my total here. But in fact, there's only one of them. So anyway, I'll just stick with the format. So my total fixed cost comes to 100,000. So then it's going to be my contribution minus my fixed costs, give me a profit of 300,000. So there is the original budgeted profit. The original budgeted profit was 300,000. Plan, sell 50,000 units, make 300,000. Okay, so do remember when we're doing this, as I mentioned earlier, you can pause, rewind, play at any time. But what I'm going to do is, it's got a little bit messy here, so I'm going to just tidy it up. There we go there. So we have those figures in. And now what we're going to do is we're going to move on to pop in the actual results. So now, to start with the actual results, we need to first of all have a look and see what is the actual level of activity. So if I go back to the question here, we can see that the sales, the actual sales, were 48,000 units. So I'm just going to pop that in. So we've got 48,000 units. And then the rest of the information I'm going to put in here. And I really don't have to do an awful lot of calculations. I'm just going to copy straight from the question, except I have to put it into a marginal costing format. Notice I'll group the variable costs together, work out the contribution, group the fixed cost with only one of them together, and work out the profit. So looking at the question here, this is the information I need. And I actually know the profit figure, so I know whether I got it right or not. So I'm just going to copy this in, 964,000 for the sales. These three figures here are the variable costs, 372,300, 147,000 and 75,000. So I'll pop those in. So I have 964,000, the actual sales revenue, 372,300. Materials, direct materials, 147,000. The direct labor, and 75,000 variable overheads. Now, that comes to a total of 594,300. So now what I'm going to do, I'm going to take my sales revenue minus my variable costs, and that'll give me a contribution, which should be 369,700. The actual fixed cost figure was 95,000. So that'll give me a total of the fixed costs, 95,000. So I'll have my contribution minus my fixed costs will give my actual profit of 274,700. And of course, I just go back and check that. You can see the profit here, down the bottom here. It is 274,700. So I have popped in here the actual results in a marginal costing format, and I've done it correctly. So I'm just going to tidy this up. So if I tidy this up, that's what we get. Now I'm going to do my flexible budget. Now the flexible budget is what we would have expected to happen given the actual level of activity. Now the actual level of activity is that they produced and sold 48,000 units. So therefore, given that as a fact, what should have happened? Well, those 48,000 units should have been sold for €20 each, which would give the sales revenue of 960,000. Those 48,000 units should have used 750 worth of materials per unit. That is 360,000. The direct labour, €3 per unit times the 48,000, 144,000. And the variable overheads, 150 per unit times the 48,000, which is 72,000. So if I add those three together, so the total variable cost then comes to 576,000. So it's going to be sales less the variable costs will give you my contribution, which will be 384,000. So remember, this is what the contribution should have been, given that the actual level of activity was 48,000 units. The fixed cost shouldn't have changed. They should remain at 100,000. So I'll just put the total of the fixed costs in there, take it away, and I get 284,000. Okay, so that is my flexible budget. So the original budget was to produce a profit of 300,000. Given the fact that the volume fell, given the fact that only 48,000 were sold, we would have expected the profit actually to decline to 284,000, but in fact it declined to 274,700. So it's dropped a little bit further than we anticipated. Okay, so what I'll do is I'll tidy this column up here before we look at the variances. There we go. So now with the variances, what I'm going to do is I'm going to calculate the sales variances, the sales price variance, the cost variances, got the variable cost, three of them there, and one fixed cost variance, and then we'll have a look at the volume variance. So starting off with the sales price variance, I'm going to compare these two here. Now what I do is I get the difference, and the difference is 4,000, and then I have to label it with either adverse or favourable, an A or an F for adverse or favourable. Now all things being equal, we would have expected the sales revenue to be 960,000. It in fact was higher, it was 964,000, so that is good. Given the fact that the sales revenue fell, or the sales units fell, we're actually done a little bit better than we anticipated. Here we can see that given the fact that 48,000 units were made, the material cost should have been 360,000, in fact it was 372,300, so that's a difference of 12,300. We have a cost that is increased, so that is an adverse variance. Likewise here with the direct labour, it's gone up from 144 to 147, so 144 what it should have been, 147 what it actually was, so that's the difference of 3,000, and that's adverse. And then also with the variable overheads, that's gone from what it should have been, 72, up to 75, so that is a difference of 3,000, which is also adverse. Okay, now down to the fixed overhead cost variances. We can see the difference there of 5,000. Fixed overhead costs actually come in 5,000 less than we would have expected, so that is favourable. And now we want to look at a volume variance. So up here, if we just use a little sort of shorthand notation, we have a sales price variance. So looking at the impact price had on the profitability. We have a material cost variance. we have a direct labor cost variance, we have a variable overhead cost variance, and we have a fixed overhead cost variance. So all these here are their cost variances. Now I'm going to use the contribution to look at the volume variance. The fact is the volume fell from a budget of 50,000 down to 48,000. All things being equal, that would have caused the contribution to drop from 400,000 to 384,000, which is a drop of 16,000. So the fall in volume, all things being equal, would have caused the contribution to drop by 16,000. So therefore, that is an adverse variance. So what I'm going to do is I'm going to tidy that up, and I'll highlight the relationships here so you can see which variances or which numbers we compared to calculate the variances. Also, do remember you can pause, rewind, and play at any time. So just tidying this up, this is what we end up with. So this here then is our budgetary control statement. So this budgetary control statement completes part A of the question. So what I'm going to do is just go back to the question itself and have a look and see what we're asked to do. So if I go back to the requirements, we can see A we've completed, and now we're going to calculate the material price and usage variance and the labour rate and efficiency variance. So if I just go back to my budget control statement here, what I'm effectively doing is I'm going to take this variance here and I'm going to subdivide it down into its component parts, a price and a usage component. And then I'm going to take the labour, which is this here, 3,000 adverse, and divide into its component parts, a rate and efficiency. So if I go and have a look at that, I'll start with the materials first, and then I'll do the direct labour. So, having a look here, material variances. So I'm going to start off with the material price variance. So what I'm going to do is compare the actual price with the standard price and multiply it by the actual quantity used. So this is the actual price per unit of materials, the standard price, and the actual quantity. So now if I just go back and have a quick look at that. So we can see here the direct materials, the standard price is €5 per litre, the actual price per litre we'll have to work out, and the actual quantity is 73,000 litres. So if I go have a look at that then, so I have the standard price, I have the actual quantity, so I need to work out the actual price. So the actual price was the amount we actually paid, 372,300, divided by the number of litres we actually purchased, which is €5.10. So therefore the price variance will be actual price, €5.10, minus the standard price of €5, that's a 10-cent difference, times 73,000 litres. So that will give us a variance of €7,300, and since the actual price is higher than the original standard, it is an adverse variance. So that's the material price variance. Now I look at the material usage variance. So this is comparing what we did use with what we should have used. So I'm going to get the actual quantity compared to the standard quantity, and I put into monetary terms of the standard price. Now here you can see I have the actual quantity, and here I have the standard price. So the only information I need is the standard quantity. Now the standard quantity is the amount that should have been used given the actual level of output. So if we go back to the question here, we can see each unit should have used 1.5 litres, and we actually produced and sold 48,000 units. So 48,000 units by 1.5 litres per unit, well, that would give us 72,000 litres. So that's the standard quantity. So just have a look here. We fill this in here. So standard quantity, 48,000 units actually produced. Each unit should have used 1,500 litres, so that's 72,000 litres. So now I have 70,000 litres that should have been used, 73,000 litres actually used, and then I multiply that by the standard price to get the variance. So that is a variance of 5,000 adverse. Now if we take this here, 7,300 adverse, that is the material price variance, and I take the usage variance, 5,000 adverse, that gives me an overall 5,300 adverse material variance. if you just go back and check the question, you can see that's that figure there. So what I can now say is that 12,300 adverse material material cost variance can be subdivided into a material price variance of 7,300 and a material usage variance of 5,000. Both of them being adverse. And remember, it's always the case, the sum of the two should give us the total figure. Okay, so now I'm going to have a quick look at the labour. So if I just move on here, I've got the labour variances. So I'm going to have a labour rate variance. So I'm going to have a quick look at that. And what I'm going to compare is the actual price paid per hour of labour with the standard price per hour of labour, and I multiply by the actual quantity, which is the number of hours. So back to the question here. The standard price for labour is €3 per hour. Then down to the actual information, 49,000 hours is the actual number of hours, and the actual price paid per hour, we have to work it out, is going to be €147,000 divided by the 49,000 hours. So I'll work that out here. So the actual price, as I said, €147,000 divided by 49,000 hours gives us €3. Okay, so this is interesting because the actual price is €3 and the standard price is €3, which means we have a 0 is the difference, or we have a nil variance. Unusual, but does happen occasionally. So that's the labour rate variance. So now we have the labour efficiency variance. How efficient were the workforce in doing the job that they actually did? So I'm going to compare the actual quantity, number of hours that they actually worked, with the hours that they should have worked, and I put the monetary terms at the standard price. So again, like the last one, I have the actual quantity, that's 49,000 hours. I have the standard price, that's €3 per hour. So the standard quantity, so can I have a look at the question? So it should take 1 hour to make a unit, and they actually produced and sold 49,000 units. So all things being equal, we would have expected the workforce to work 48,000 units produced at 1 hour per unit. So that's 48,000 hours. As I said earlier, they actually did work 49,000 hours. So putting that in there, we have a total variance of 3,000. Now they worked more hours than they should have, so costs are up, so it's a 3,000 adverse variance. So if I take this out here, we have a nil rate variance. We have a €3,000 adverse efficiency variance, which gives me a total direct labour cost variance, adding those two together, of 3,000 adverse. And if I go here, I can see that's exactly what I was expecting to get. Okay, so that is the labour rate variance and the labour efficiency variance. So what we do is now we just go back to the beginning, back to the question, and have a quick look at it. So here we are back to the original question, and we just have a look and see what we're asked to do. Prepare the budget control statement in a marginal costing format, showing the number of columns, the original fixed budget, the flexible budget, actual results, and the variances. So we've done that, and then we've calculated the following sub-variances: material price and usage, labour rate and efficiency. So that's the end of the question. So do remember that if you want to look at further questions in this area, you can check my website, danielkaccounting.wordpress.com, where you can download other questions in PDF forms and get links to video tutorials. Okay, I hope you found that beneficial, and thank you very much.